Okay, we're recording this video on Thursday, the 22nd of December 2016. Hope you're doing well, hope your trading is going well, and I hope you're looking forward to Christmas. As you would expect, coming up to Christmas, the markets have got very quiet. Although Thursday, today, things have perked up a little bit. But my God, Monday, Tuesday, Wednesday, were they slow? Extremely light volume, very slow, almost no volatility or range kind of going on. So best to be very careful on days like that. I always find it's best not to trade when the market's that slow, just because trending moves don't have any follow through. You get yourself in trouble. Anyway, got a very nice email from TK this week about Larry Williams, and I've had this presentation kind of on the go for a few years, and I just thought, well, with the little bit of downtime I got, let's finish this thing up and get it out. But let me read you the email from TK first of all. It says, "Dear Barry, hope you're well. It seems you have a special place in your heart for Larry Williams. I wonder if you might consider a video about Larry and what you like about him. I visited his website. He has a lot of information to try and absorb. As a Better Indicator subscriber, I was wondering if there's one thing or another we could review from Larry's site to gain a little more trading insight. Thanks, Barry, TK." Well, I think there's a huge amount we can learn from Larry Williams. So let's get into it. First thing to say is a little bit of a caveat. Larry Williams is a hugely polarizing character in the trading community. You kind of either love him or you hate him. And he comes in for a lot of criticism online. And I must admit, I think a lot of it is just totally unjustified and kind of driven by a lot of jealousy. The story behind Larry Williams, he kind of burst onto the scene, I think in about 1987, when he won what used to be called the Robbins Trading Company kind of trading competition. I think it's now the World Cup Trading Championship. But anyway, he turned a $10,000 account into over $1.1 million in the space of 12 months. He actually turned the account into over $2 million, but in a couple of final trades that he made, they kind of didn't work out, and the account ended up being closed out at $1.1 million. Not only that, he then 10 years later taught his daughter, who is the actress Michelle Williams, to trade. She also entered the same competition run by Robbins Trading and won it in the year that she competed. So she went from kind of almost zero trading experience to winning an extremely prestigious trading competition. So based all on Larry Williams' principles. So he's kind of famous for that. Then, of course, he's written a large number of books, I think it's about 11 trading books or so, done a number of speaking gigs around the world, and he also used to run the $1 Million Challenge kind of trading series. So that's kind of the story. Personally, I think he is, number one, a genius. Number two, incredibly generous with all the things that he has published and talked about. And he is a super nice guy. I've met him on a number of occasions, and just a genuinely, good guy. Now, what can we learn from any trader? I always come back to this. It's a great quote. It's a Bruce Lee quote. Absorb what is useful, discard what is useless, and add what is uniquely your own. You never go to trade exactly like another trader, but study what they do, understand what they do, and take what works for you. I just think that's just good advice for anything you kind of read or learn or see online, in books, wherever, about trading in general. It's such a personal thing. You need to take the ideas that resonate with you and work on those and make them your own. That's the best way to trade, rather than try and mechanically follow what someone else is doing. Now, why should you listen to me about Larry Williams? Well, first of all, I've read pretty much everything he has ever written, even some of the obscure books that you can't find on the shelves anymore. If there was one book that I'd recommend as an E-mini trader that is really worth getting, it's called The Long-Term Secrets to Short-Term Trading, and that book is really focused on trading the indices and the bonds, but that's a very solid book. So if you want to pick up anything and read anything of Larry Williams, that would be number one kind of suggestion. I basically saw him every time he came to speak in Sydney when he used to come on a regular basis. And eventually I signed up for the $1 Million Challenge in 2001, so that's 15 years ago, which kind of makes me feel very old. But That was quite a big deal for me. At the time, it cost me 6,000 Aussie dollars to attend that. It was a 3-day thing. We started on a Sunday afternoon, where he kind of went through his principles and taught us as much as he could about trading his way. And then we actually traded the E-mini markets during the day session, which was kind of starting at midnight in Sydney time on the Monday and the Tuesday. The deal with the $1 million challenge, the whole idea was that he would trade his $1 million account, and then he would share the profits with people who attended. 20% of the profits were to be split among the attendees, and I think there was probably about 15 of us who were at that particular session back in 2001. Unfortunately, he didn't end up making money that kind of session, and so we kind of never got a refund of the cost to attend the MDC, but I still think of it as kind of money well spent from my perspective. It was about the time when I was saying that I needed to take my trading really seriously, and so it was one of those things that I did that kind of kicked me into a higher gear. So that's why I know kind of a little bit more than most about Larry Williams, that I've actually kind of attended the MDC and traded with him. However, I have to say, since then and the couple of years after that MDC in 2001, I really haven't kept up, because I kind of went off on my own tangent, and so I've not kept up with his latest kind of ideas, but I'll give you as much insight as I can without breaking any confidences about the way he trades and what you can learn, or what I have learned from it. In short order, this is Larry's kind of trading methodology, kind of broken down as best I can summarize it. He says that he is not a technical trader, doesn't rely on technical analysis, if you like, and this is why he says that, because he says the setups are based on fundamentals, kind of good reasons for getting into trades, are kind of long or short, and he uses 3 major market indicators in order to figure out where some setups are happening. First one is commitment of traders. He was one of the first into the commitment of traders kind of analysis, and he's written a number of books based on that. The second one is intermarket relationships, and these are relationships between the equities market and bonds and gold and so on, and those intermarket relationships are very important for him. And then lastly, a lot of work to do with seasonality and multi-year patterns. So not just kind of month to month in different markets, and particularly with some of the commodity markets, seasonality is incredibly important, but also multi-year patterns. So for example, the 4-year cycle in the stock market, which is heavily driven by the presidential election cycle, and then a 10-year cycle that he's identified in the stock market, and so on. So not just kind of shorter term stuff year to year, but also multi-year type patterns. So the setups, the ideas for the trades are coming from those kind of fundamentals: commitment of traders, the intermarket stuff, and seasonality. Then to actually trigger trades, he's basing a lot of his entries on patterns. And then lastly, in terms of the exits, how he gets out of trades, there's a couple of ways he gets out. The first one is famous exit called a bailout exit, which is the first profitable open. Now remember, a lot of Larry Williams trades, and I would suggest the majority of them, are swing trades. He's not really a day trader. He is swing trading futures, commodities, and so on over a number of days, and maybe as much as 10 days or so. But the first profitable open, so the next day's open, if you have a profit on an open trade that you have, you get out at open at whatever that profit is. If it's a positive profit, you kind of get out. If it is negative, if you're losing position, you kind of hold to the next open to see if it's profitable, and so on. Then there's also kind of the number of days. He might be in for 3, 5, 7, 10, something like that. He'll put in a number of days as a type of exit, a kind of mechanical exit. And then lastly, just on a stop, he tends to have very wide stops on his positions, and so that kind of keeps him in trades a little bit longer. It's a source of a lot of criticism, a lot of traders kind of saying that the wide stops is kind of crazy with the amount of capital that he has to trade in order to make those wide stops work, but they do work. So there we go. That's in a nutshell my view of Larry Williams' kind of trading methodologies: setups, entries, and exits. So what can I pass on in terms of lessons learned from trading with Larry Williams? And I've got 6 of these that I want to kind of pass on to you. just little general principles about trading, not passing on any kind of confidences, no specific setups that I'm going to suggest or anything like that. But these are just general principles, things that I kind of observed and learned from reading and watching kind of Larry trade. So the first one, lesson number one, is use the market's tendency to revert to mean. The market is either in a kind of horizontal kind of channel and bursts out of that channel, it'll want to kind of come back into the channel, or it's in some kind of trending phase, either up or down, and it temporarily gets overbought or oversold. The market will want to come back into a mean kind of reversion kind of position. So periods where psychologically things get kind of out of kilter temporarily get sorted out by kind of coming back to the mean. And this was kind of made clear to me, either it was the second or the third day of the MDC, and Larry was explaining one particular setup. He was very keen on where the open was of the market compared to the close, the high and the low, and so on of the previous day in relationship with various kind of other market moves that were happening at the same time. And someone in the audience kind of says, well, what happens if the open was, further away, for example? And Larry went and coded that using his Genesis software, which is very powerful for trading patterns and using intermarket relationships to figure out back testing whether things work or not. And he said, yeah, that would be a great trade because it kind of tests well, and the open in that particular position would kind of lead to a winning trade. And then the trader comes back and says, well, what if the open was somewhere else? And again, and it seemed to me that what Larry Williams was doing was actually kind of the further away from this kind of mean, the more likelihood that trade was going to be a good trade. And he was always looking for those opportunities where the open got kind of out of whack, was out of position compared to historically where it had been, and he was looking for options to kind of close that gap and the market to revert to mean. So the market reverting to mean is a very strong force in the market, and he was using that to look for trading opportunities. So that's the first lesson. The second lesson is that the market is more often random than rational. Now, I put quotes around these. These aren't actual things that Larry Williams has said, but it's my view on what effectively he is saying. And again, this came from a question, would have been the second day, where one of the traders asked, what is the one thing that you've learned in trading that is kind of the best idea that ever kind of came to you? And he said it was the bailout exit, and this is exiting on the first profitable open when you're swing trading a position. He said he hadn't actually come up with the idea, but he'd done so much back testing on the idea, he felt as if it was his own. And I think when it comes to the literature, he's probably done more work on this than anybody else. The bailout exit works with a large stop because you are using the market's randomness and volatility to get out based on a position being profitable. And so it basically says, if you've got a profitable position, exit, get out. And so it's the combination of using a first profitable open with a large stop, those two things together. The large stop allows you to sit through quite a lot of volatility in the market, and then if you happen to have a profitable open position, close the position out, take your money. So the market is more often random than rational, and so your attitude to trading should take that into account. And I think that's really a very important lesson, that we try to see logic, and that the market being up or down on a particular day or trends in a particular direction, why does it do that? There's no kind of rationale to it. I think you can look at the stock market and look on a longer term basis, a medium to long term basis, and yes, come up with some rational reasons why the market did that. But minute to minute, hour to hour, even sometimes day to day, the market is just oftentimes irrational and more random than actually moving in a particular direction for very good kind of fundamental reasons. Lesson number 3, failed technical patterns are often the best trades. This one is really the result of technical analysis and trading books becoming so pervasive. There's been so much written about trading patterns and that you can almost fade popular trading patterns. These days, those patterns are so well known by all the players that in fact The strongest moves come when you fade these well-known patterns. So let's take, for example, a pattern, a candlestick pattern like a shooting star, which is where you kind of gap up and then we make new highs and then we close on the lows or something like that of that day. And the general consensus in the marketplace that would be kind of a blow-off move, that a lot of people have kind of will see that as a bearish breakout because we kind of closed on the low, having made new highs and kind of gapped up and so on. Well, if everybody looks at that pattern and says, well, it's time to short, there's a lot of stops sitting above the high of that bar, and if the market trades above that, you're going to bust out all those people out of their stops in that position, and you're going to cause a rally in that market. So when common, well-known, traditional kind of technical patterns fail or are faded by the real professionals, they end up being very good trades because so many people in the market, more the amateur side of things, have taken an obvious trade and so will get stopped out when it doesn't kind of work to plan. So those are really worth kind of looking out for. Okay, next lesson, lesson 4. Use the market's volatility and cycles in market volatility. I think there are so many things, relationships that are ethereal in trading. They'll work for a while and then they'll break down and they'll reverse and kind of go the other way. And there are very few things that you can rely on, not just kind of week in, week out, month in, month out, but year in and kind of decade in, decade out. There are two things though. One is day-to-day kind of volatility cycles. The market goes from periods of being very active to very quiet to very active to very quiet. I don't think that will ever change. That will never stop. And so use that to your advantage. If you've had a couple of super big range days in a row, chances are the next day is going to be quiet. If you've missed out on trending moves during big range days, don't expect the same activity after kind of big ranging days. And then if you have a series of days where things are very quiet and very subdued, eventually you'll bust out of that into larger kind of range days and big kind of trending days. So that's one kind of aspect of cycles in volatility. And that is a relationship that will just continue on ad infinitum. That's kind of a psychological human type thing. The second one is the daily range, and that's using kind of big days to get on top of big moves. So when you've got a big day kind of setting up like an open range breakout, those things will tend to travel and go the distance and you end up with kind of big range days. I think those types of days will always persist. If you can find them, there will be good trading opportunities. Don't expect every day to be a trend day, but when you do identify kind of trending days, big range days, jumping on board those kind of opening range breakout type trades will always be kind of a winning proposition. There'll be good times and bad times, but over the long period of time, opening range breakouts and cyclical changes in market volatility are good principles to build into your trading approach. So that's lesson number 4. Okay, the next lesson, lesson number 5, use intermarket relationships to filter out losing trades. Now with this particular lesson I put a cross against it. The other ones I've got kind of ticks against them because I agree with them. These I don't, the next two I don't actually agree with. Whether I think it's a strong no, as in a cross here, or just a big question mark, is probably more appropriate that I say I'm kind of the jury's out, I'm not so convinced about this. But in Larry Williams' setups and trades, he relies heavily on intermarket relationships, particularly when he's trading the equities market, looking at the bond market, and then trading the bond market, looking at the gold market. I am not convinced that these are kind of long-term relationships kind of hold up. He is looking at patterns, looking more at the current trend, the short-term trend in these markets against each other rather than kind of long-term correlations between them. But still, that being said, I'm not convinced that these kind of relationships will hold for the long term. For me, the thing that changed was in the financial crisis 2008. A lot of these relationships that kind of looked good and worked well for years and almost decades prior kind of broke down entirely. And I still think with the global financial crisis that we're through the looking glass. Everything's upside down, with the advent of quantitative easing, with the advent of kind of bank bail-ins and bailouts and all the crazy funny stuff that we're doing in financial markets, and the central banks around the world getting involved, taking positions in equities and corporate bonds and so on, all this kind of crazy stuff. The world has changed, and I don't believe that these kind of intermarket relationships can be relied on for the long term. So if you build a trading system based on kind of short-term trends in bonds versus equities or gold versus bonds, whatever it might be, I am not convinced that those are going to work out in the long term. Your historical system testing results might show that they kind of work historically, but looking out into the future, are they going to hold up and still work? And I'm just not convinced that that's going to be the case kind of going forward. So a lesson learned from me was these intermarket relationships as a trading idea. For me, I kind of had to give that away and say, no, I'm not going to kind of get involved in that. The last lesson, lesson number 6, again is another kind of cross for me. I feel a little bit more strongly about this one. And, Larry Williams might say something like, don't be a slave to sample size and statistical significance. In the back testing that he does of his patterns, particularly with the intermarket relationships, sometimes the sample size of the trades that are taken is scarily small, in the teens or in the 20s. And although the results might look, really good with high percentage profitable result, a lot of that is being driven by the bailout exit, which is just using any profitable open to exit a trade and having a very large kind of stop, and just as a result of the market volatility and fluctuations to generate kind of system results, rather than real relationships between patterns and intermarket relationships. Larry would probably say it's okay to rely on kind of smaller sample size. Again, the criticisms that he would get in the market is that the sample sizes are way too small and there is absolutely no statistical significance in the results that you're getting, and so you shouldn't rely on these patterns kind of going forward. So I'd be very wary of using small sample sizes, to kind of build supposedly a robust kind of trading system that's going to work for years and decades in the future. So there we go, kind of 6 lessons from me. Just a quick kind of recap. Use the market's tendency to revert to mean. Number 2, the market is often more random than rational. Number 3, failed technical patterns are often the best trades. And number 4, use the market's volatility and cycles in market volatility to your advantage. So I would use those 4 kind of trading rules, lesson learned, as being useful. But watch out for intermarket relationships. I'm not sure they're kind of going to work out as they always have worked out in the past. And be very careful of small sample sizes when you're deciding on system trading. What was, for me, the personal aftermath of trading with Larry Williams at the $1 Million Challenge? The first thing was I built myself what I thought was the perfect kind of system, but at the time, the way I was coding with TradeStation, I was not able to kind of incorporate the intermarket relationships successfully. That is a tricky thing to do with TradeStation and easy language. The Genesis software that Larry Williams uses is perfect for it and was almost built to do that, but the easy language stuff in TradeStation at the time was very difficult, and so I kind of kept that out. I built myself what I thought was a perfect system, and then within about 3 months of running it, it blew up and I kind of blew up my account. So that was a personal lesson learned. And totally my fault, nothing to do with what I learned from Larry Williams, and I just shortcut something to try and make something work. However, it did get me kind of switched out of a purely kind of systematic approach to a far more discretionary approach, and it reinvigorated my trading and research, and it kind of spurred me on to a number of years of, from my perspective, very fruitful research. So the direct aftermath for me, although I ended up kind of blowing up my account, was a very productive period. And so I have to say thank you to Larry Williams. He's a great guy, he's a genius, he's incredibly generous with his research and his work. read whatever you can, watch as many of his videos as you can. Go back to, the Bruce Lee quote: absorb what is useful, discard what is useless, and add what is uniquely your own. So he is a font of knowledge for trading futures, commodities, short-term trading, swing trading, you kind of name it. There'll be ideas that you can glean from his work. So there we go. TK, that is kind of lessons learned from trading with Larry Williams from my perspective. Do hope that was helpful to you. Hope your trading is going well, and happy Christmas to you.